In the years leading up to the 2008 financial crisis, Lehman Brothers lived inside a world where confidence was oxygen. Investment banks depended on short term funding, trading counterparties, and client trust, often renewed day by day. When markets were calm, that system felt routine. When markets grew nervous, the same system became unforgiving. A single bad headline could raise funding costs, shrink liquidity options, and trigger a spiral of doubt. By 2007 and into 2008, the environment around mortgage linked assets and structured credit was changing quickly. Investors started asking sharper questions about exposures, leverage, and the reliability of reported numbers. For a firm like Lehman, leverage ratios were not just an accounting statistic, they were a signal to the market about survival. If leverage looked too high, lenders and counterparties could pull back. If leverage looked stable, the firm could buy time. This is the setting where Repo 105 enters the story, an internal label for a specific way of accounting for certain repurchase agreements. In normal practice, a repurchase agreement, or repo, is essentially a short term financing. One party receives cash and provides securities as collateral, while promising to repurchase those securities later. Most repos are accounted for as financings because economically they function like secured borrowing. Repo 105 was different because it was structured to meet a technical threshold that could allow it to be recorded as a sale rather than a borrowing, at least in Lehman's internal approach. The 105 label referred to the collateral level, securities valued at about 105% of the cash received. That over collateralization was used to support the sale accounting treatment in the way Lehman pursued it. The bankruptcy examiner's report later described this as an accounting device used for short term balance sheet relief around reporting periods. The purpose, as described in later investigations and reporting, was not primarily to fund a long term business plan. It was to temporarily reduce the reported size of the balance sheet and make leverage appear lower at quarter end, then reverse the transactions shortly after the reporting date. The examiner later pointed to internal descriptions that characterized the practice as a gimmick, emphasizing that it appeared designed to change the look of reported numbers rather than the underlying risk. What makes this story educational is the tension between form and substance. On paper, a transaction can be structured to meet a definition. In reality, investors care about what the transaction does. Repo 105, according to the examiner, created a short window where leverage looked better than it truly was, precisely when public reporting captured the firm's financial position. In a documentary tone, you can imagine the quiet urgency inside the organization, the close of the quarter approaching, the market watching, the firm trying to manage optics while also managing real funding pressure. Repo 105 offered a kind of temporary relief, numbers that looked cleaner at the moment they mattered most, but the relief came with a cost. It pulled attention away from the deeper problem of business model fragility in a stressed market. And that is where the story begins. A firm trying to preserve confidence, leaning on a technical accounting approach that made leverage appear lower at exactly the time the world was measuring it. To understand Repo 105 in an educational way, it helps to focus less on jargon and more on the timeline of incentives. A standard repo is simple in economics. You receive cash today and agree to buy back the same securities later. That is why most repos are treated as financings. You still bear the economic exposure to the securities, and the cash is essentially a loan secured by collateral. Repo 105, as described by the Lehman bankruptcy examiner, was structured so that Lehman recorded it as a sale. This accounting choice mattered because it allowed Lehman to remove the transferred securities from the balance sheet temporarily and use the cash proceeds to pay down other liabilities right before financial statements were prepared. When liabilities went down and assets went down in step, reported leverage could improve, at least for the snapshot captured at period end. Then, after the reporting date, Lehman would enter new financings and reverse the earlier steps, effectively bringing the balance sheet back to its prior size. The examiner described Lehman's use of these transactions as reaching very large amounts near quarter ends, tens of billions of dollars, creating a meaningful change in reported leverage. A widely cited figure in commentary on the examiner's findings is up to $50 billion in temporary balance sheet reduction in certain periods, which the Yale Journal of Financial Crises case study also emphasizes in discussing the examiner's conclusions. One key detail that appears repeatedly in the public record is that Lehman sought true sale legal opinions under English law. The Stanford hosted document set includes materials indicating that Lehman viewed repos generally as difficult to treat as sales under U.S. law and therefore relied on an English law structure and opinions for Repo 105 and a related approach sometimes labeled Repo 108. That legal architecture matters because it shows how the firm navigated boundaries. If an approach could not be supported cleanly under one jurisdiction's framework, it was supported through another. This is not by itself proof of wrongdoing. Cross border legal opinions exist for many legitimate reasons, but it becomes ethically and governance relevant when the apparent business purpose is primarily reporting presentation. The most important educational lesson in this part is the difference between managing risk and managing appearance. Firms do legitimate balance sheet management all the time, raising longer term funding, selling assets, reducing exposures. Repo 105, as characterized by the examiner, was different because it was designed to create a temporary reporting effect without a corresponding long term reduction in risk. When markets are calm, that kind of technique might pass with little attention. When markets are unstable, it can become dangerous because it feeds a false sense of security both inside the firm and outside. Numbers that look safer can delay harder decisions, raising capital earlier, shrinking the balance sheet structurally, or reducing fragile funding dependence. So, Repo 105 was not just an accounting story, it was a story about time, about creating the appearance of strength for a reporting moment in exchange for making the post reporting period more complex, and more dependent on continued market access. When Lehman collapsed and entered bankruptcy, the question was no longer academic. Investigators had to reconstruct what the firm knew, what it intended, and what it disclosed. The bankruptcy examiner, Anton Balukas, produced a detailed report that became central to how Repo 105 is understood publicly. A pivotal theme in the examiner's account is intent, whether Repo 105 was used mainly for genuine financing needs or mainly to alter reported leverage at quarter end. The report points to internal communications and descriptions that suggested the transactions were used for balance sheet relief, implying a reporting-driven motive. In public discussion of the report, analysts highlighted language describing Repo 105 as an accounting gimmick, which signals how it was perceived even within the organization. The human side of this story matters. Complex financial events often look, from the outside, like machine logic. Inside organizations, they are shaped by people, executives under pressure, finance staff trying to hit targets, risk teams trying to keep pace, auditors balancing skepticism with client relationships, and employees debating what is acceptable. The examiner's narrative also drew attention to questions around oversight and whether key stakeholders received timely warnings. In particular, post-reporting commentary noted that concerns existed about whether the board-level audit committee had full visibility into Repo 105 practice and its implications. A Wharton analysis of the examiner's report discusses the criticism directed at the audit process and the question of whether warning signs were escalated effectively. This is where the educational lens becomes powerful. The most practical lesson is not memorize Repo 105. It is when a reporting-driven tactic becomes large, repetitive, and time-linked to disclosure dates, governance must become stricter, not looser. If a transaction exists mainly to produce a quarter-end picture, it demands higher scrutiny because it can mislead stakeholders who rely on that picture. Another lesson is materiality. Even if a technique is technically permissible within a narrow framework, it can still be materially misleading if it changes how reasonable readers interpret leverage and liquidity risk. In the examiner's telling, the size of the transactions and the timing around reporting dates made them important for investor understanding. Then there is the subtle signal that appears in many corporate failures, language inside emails and internal notes. When staff begin describing a practice as a workaround rather than a strategy, it indicates a cultural shift. It suggests the organization is optimizing for metrics, sometimes at the expense of clarity. In calm storytelling terms, Repo 105 becomes a mirror. It reflects how a firm's culture responds when the market demands reassurance. Does it respond by changing the underlying risk profile, or does it respond by changing the presentation of that profile? The examiner's account helped the public see Repo 105 as part of a broader pattern, an institution using complex mechanisms to preserve confidence in a weakening environment. And once confidence is what you are manufacturing, the business becomes fragile because confidence can vanish faster than any quarter-end maneuver can restore. Financial reporting is, in many ways, a collection of snapshots, assets and liabilities measured at a specific date, then explained through footnotes and management discussion. Investors know a snapshot can be incomplete, but they rely on the assumption that the snapshot is not intentionally staged. Repo 105, as portrayed in post-collapse investigations, was powerful precisely because it exploited the snapshot nature of reporting. By reducing the balance sheet right before the reporting moment and reversing the change shortly afterward, the firm could present leverage that looked better at the point of measurement than it was during the surrounding weeks. This is not merely an accounting technicality, it is a communication issue. In stressed markets, investors are not just buying assets, they are buying narratives about stability. A leverage ratio is a compressed narrative. It suggests how sensitive the firm is to asset value changes and how dependent it may be on ongoing funding. If that ratio is made temporarily smaller right at quarter end, the narrative becomes rosier than the lived reality. The public record around Repo 105 also emphasizes the role of legal opinions and documentation choices. The Stanford-hosted document set includes references indicating Lehman sought true sale opinions from a UK law firm for Repo 105-108 transactions documented under English law. That architecture underscores how reporting outcomes can shape structuring decisions. An educational point here is that accounting standards often require judgment. They cannot anticipate every structuring variation. That is why the system depends on professional ethics and governance. Just because something can be argued does not mean it should be used to shape market perception in a fragile period. This part of the story also touches the role of auditors and how they evaluate substance over form. Public reporting after the examiner's report debated whether the audit process adequately challenged the use and disclosure of Repo 105. Reuters coverage at the time discussed a letter connected to investigations and references to Repo 105, reflecting the intense scrutiny on how the accounting was handled. The broader lesson for audiences is about visibility. Risk does not only come from what you hold, it comes from what others cannot see clearly. When transparency declines, counterparties grow cautious, funding becomes more expensive, liquidity options narrow. Even if a firm is trying to buy time, reduced transparency can shorten the time it has. Repo 105 therefore becomes a cautionary tale about financial storytelling. If a firm uses complexity to make itself look safer at the reporting moment, it may gain a temporary headline benefit, but it risks deeper damage when the technique is revealed. In finance, revelation can be more costly than the original weakness because it damages trust. In documentary terms, this is the quiet tragedy. The firm attempted to reassure the world with cleaner numbers, but the method of producing those numbers contributed to the very mistrust that made survival harder. When Lehman filed for bankruptcy in September 2008, It triggered years of legal, regulatory, and reputational fallout. Repo 105 became one of the most discussed elements because it offered a concrete mechanism that seemed to connect internal reporting decisions with external perception. The bankruptcy examiner's report, widely cited and heavily footnoted, provided a framework that shaped public understanding. It described Repo 105 as an accounting device used repeatedly at quarter end and raised questions about whether stakeholders received a complete picture of leverage and liquidity. The aftermath also included scrutiny of professional gatekeepers, auditors, and advisors. Public debate focused on whether the accounting treatment and related disclosures were challenged strongly enough. Over time, this scrutiny fed into legal actions and settlements. A notable example is the New York-related settlement involving Ernst & Young years later, which press coverage linked to the Repo 105 matter. For an educational documentary, the goal is not to turn this into courtroom drama. The more useful lesson is how accountability systems behave after complex failures. Investigations reconstruct incentives. They look at timing, internal language, and repeated patterns. Regulatory focus often lands on disclosure. Even when technical compliance is arguable, disclosure failures can still be central. Professional relationships are examined. When a firm is a major client, the independence of challenge becomes a vital question. The story also highlights a truth about complex institutions. Responsibility is often distributed. Executives sign off on public narratives. Finance teams design reporting processes. Risk teams monitor exposures. Auditors test assumptions and disclosures. Advisors provide opinions. When something goes wrong, each group can claim it was only one piece of the machine, but the market experiences the outcome as a single failure of trust. Another key educational theme is that post-crisis reforms often aim to reduce the space where snapshot engineering can happen. Regulators and investors push for more transparent reporting of funding profiles, off-balance sheet exposures, and period average metrics. The reason is simple. If quarter-end numbers can be staged, then average conditions may reveal more truth than a single date. In calm language, Repo 105 became a symbol, less because it was the only reason Lehman failed, and more because it represented a mindset, a belief that presentation could substitute for structural repair. When the market is stable, presentation tricks can seem harmless. When the market is unstable, they can become accelerants. So the aftermath of Repo 105 is not just punishment or blame, it is a case study in how modern financial systems try to learn, imperfectly, after they discover that technical compliance can still produce misleading pictures. The Repo 105 story remains relevant because it teaches how fragility can hide behind sophistication. For audiences who want practical insight, the lessons are surprisingly clear without needing technical expertise. Lesson 1. Watch the timing. If large transactions cluster around reporting dates and reverse shortly afterward, the motive is likely reporting optics. Balance sheets are not only numbers, they are signals. When the signal is engineered, trust weakens. Lesson 2. Track substance, not labels. Whether something is called a sale or a financing is less important than what risk and obligation truly remain. If the economic reality is we will buy it back, then the exposure never really left. Lesson 3. Quarter-end snapshots can be incomplete. A single date can hide the lived leverage of the quarter. That is why investors often care about period average balances, liquidity buffers, and funding stability, not just end-of-quarter metrics. Lesson 4. Complexity increases the duty of clarity. If senior decision-makers cannot explain a recurring practice in simple terms, the organization is likely relying too heavily on technical framing. That is a cultural risk signal. Lesson 5. Governance must tighten under stress. The examiner's report and subsequent commentary emphasize that as conditions worsened, Lehman's reliance on balance sheet relief grew. In an ideal risk culture, worsening conditions trigger stricter limits and more transparency, not more engineering. In documentary closing, Repo 105 becomes less a single technique and more a caution about mindset. When a firm is under pressure, it can either confront the underlying fragility or attempt to manage perception. Perception management can buy a moment. Structural repair can buy survival. That is why Repo 105 matters today as an educational story. It shows that in finance, the most dangerous risk is not always the one that is largest on paper. Sometimes it is the one that is hidden in the space between what is reported and what is real.